Today we're talking about build to rent. If you've not been to the others, I'm Robert Lee. I'm a teaching associate at the Department of Land Economy at the University of Cambridge and principal lecturer in business at Wrexham University. So, build to rent, a lot of people have heard of it. Often if it's in city centres, people often associate it with that type of region. But people don't know much about it. It's kind of avoids them. They don't know much. So if you've got questions, pop them in the chat and we'll come to them towards the end. And even though we have this big category of build to rent, these are some of the largest developers that we have on our left-hand side, especially in the UK market here. So you've got, for example, Essential Living, which is a London-focused residential build-to-rent developer. You've got Dandara, who are more focused in the north of England, so in Manchester. A couple other interesting ones, Legal and General. So people have probably heard of them as kind of an insurance company, have gone into build to rent with the managing estate agent Urban Bubble. And they've been looking at building again towards the Manchester region. So Urban Bubble manage large build to rent sectors. So there's a lot of developers in this space, and we generally don't find small individual people going into build to rent. You may find that there's small investors who might build one or two, but generally to finance a large development, you need significant sums of capital. Often, and we'll talk about the financing side later on, but it's a consortium of investors or very deep pension funds with pockets, and they're looking at certain characteristics. So you generally don't find smaller landlords investing into this area. It is a new division of the private rented sector, and it's been going for about 20 to 25 years now. So it's been going for quite some time. People think it might have came about in the last 5-10 years, and that's partly because the Conservative government said that actually it's a good way of kind of promoting the private rented sector to improve their standards, which it's there to do. And we see it as a generally a positive impact for renters. So when most people think about build to rent, they're thinking actually these are purpose-built homes, which are for rentals, so people who maybe cannot afford to buy or do not want to buy a home. And so actually these are going to be well run, well maintained, and provide a really nice lifestyle to tenants. Another allure to build to rent is this idea that actually, because they're new, and what we find is with new builds, we have higher energy performance certificate ratings, so EPC. For rental houses, they need to be E or above. But with the new build to rent, you might find that they're actually an A or a B as a minimum. So much more energy efficient, saving tenants money on their utility bills. So again, a positive thing, and goes along with the environmental agenda that we have at the moment. And also, it promotes long-term tenancies. If you go into the private rented sector, a landlord will offer you maybe a 6-month AST or a 12-month AST, and not much longer. Where these purpose-built developments are solely for renting over a fixed period of time, 10 or 20 years, maybe 30. Before they might even come to the consideration of selling. So the idea is that there will be, if a tenant wants to stay and can afford the rent, they're going to be able to stay for a much longer period of time than what you might get in other sectors, with the private rented sector being quite expensive. And of course, the affordable, maybe social rents or affordable rents that we've discussed in the past, they might not be eligible to claim for that. So there's lots of positives with build to rent. And these are some of the characteristics that we assume in the bottom right. And what we care about is most importantly, the long-term viability of a build to rent development. When we're looking at build to rent, there's a few things that we might think of, which you might not put as much weight on if you're a buy-to-let landlord in the private rented sector. These are, like I said, large developments with hundreds of potentially apartments or units, and therefore they're going to have inbuilt amenities within that development. Often this might be a gym, it might be a cinema. As you can see in the picture in the left, it might be an open area for walking, talking, what have you. So there's these amenities that you will get generally for free or for a small service charge on top of your rent that you'll have access to. And this links in with the next 2 points is it gives renters a sense of place and a community in one area, that we all belong to this development, to this area, and that we're all in the same boat. One controversial kind of thing that you may end up having, though, is if you put, for example, many tenants together, could you actually be penalising the tenants and making them feel that actually we can't, all of us here in this one area can't afford a home? So actually there might be a sense of there's the us and them mentality. So it could actually be a dividing line built to rent. Again, there's not much support for that at the moment, but over time, as we've seen when you do these big developments and put many people in the same economic bracket into that one area, we see that often that goes sideways in the long term. So we're looking at building a sense of community, and then of course we're going to be running social events in this development, promoting healthier lifestyles, what have you. So often when you look at these developments, these are the things that you might see on the website. So if you go to some of these developers' websites, have a look, and you will start to see that they're selling these characteristics to the investors of why tenants might want to come to this development, and to the tenants of the benefit of renting that from that development. So let's have a look at the process of how this build to rent would work from the ground up. So there's 3 ownership structures that we should be aware of: joint venture, co-investment, and forward fund. Joint venture and co-investment are quite similar. Joint venture is generally 2 or more parties that are going to invest into a build to rent development. So you might have, say, 10 investors. They're all going to invest, say, 10, 15 million, raise, say, 100 million pounds, and they're all going to actively manage this pot. Remember, really, joint ventures is different to passive management. It's not where you're just going to passively invest and someone's going to manage it. Generally, you're going to be providing something to the table, some management expertise, financing expertise, what have you. Co-investment is, like I said, very similar with this idea that you're going to maybe have multiple investors, but often this may be more professional. So you might have investment banks, private equity firms, family funds investing as well. And they may be able to access, for example, bigger pots of debt financing, or to be able to get better, maybe they got some networks in the council, so council considerations. So very similar, but maybe a slightly more professional view is took on co-investments on that side. Forward fund is where, say, you have the financing already in place, say it's an equity investment, or you already raised the capital and the debt. What you would do is you might fund that development before it's even been completed. So you're not buying an already done investment. You'll fund the developer maybe 20% and do stage payments to a developer, and then you'll have this tailored build to rent development for you to rent out at the end. The reason you might take on that risk of forward funding without seeing the finished product is, of course, you're going to be able to buy that at a discount. And we've got an example of that towards the end of today's presentation. So these are the structures that we mainly invest through build to rent. The next thing that we're going to look at is, once we've decided the partnership structure, we're looking at the location. So we're going to be looking at what land is available and what are the local authority rules on planning for this. So, for example, in city centres at the moment and with the new government, there's a lot of promotion of land that isn't being used, especially brown sites, which might have had commercial activity on it in the past. Or if there's been maybe ugly sites, as the government calls them, i.e. not attractive to a regular investor, they may get favourable planning consideration. Of course, greenbelt land, areas of natural beauty, if we've got a national park, you'll struggle much more to get this through planning. Sometimes we look at the demographic data in certain areas too. When we're buying this land and we're going to build it, who's actually going to come and live there? Doesn't necessarily mean that it's 18 to 35-year-olds who are renting. It could be a build to rent for 55 plus. Some of the best tenants are older tenants, remember, because they stay and they don't cause damage generally. So they're going to be looking at the demographic data, but This looking at which areas do young people want to live in, because that's generally the main base of renters, people who are at the start of their life. And will they want to live here? Will the community support these people moving to this area? Does it have the bars, the nightclubs, the amenities, what have you, as we discussed about before? And also, what's the feasibility of scale? So how large can we build this? What's the actual, you end up competing with yourself eventually if you build a project too big. And because if you build too many apartments, say, there might only be demand for 50, but you've built 70. So the empty apartments that you built are just competing against one another, and you end up reducing your rents, which you need to be careful of. Once you've found a suitable location, you'll go to the architect, and they'll be looking again at some of the things that we've discussed before. So how do we build the shared spaces? That's going to be key for planning. What's the ideal community? How are we going to sell this? What features in the building will we use? Maybe communal kitchens, shared areas, libraries, what have you. Is there any USPs about the area that we that we care about? And when we're building a large development, can we do any scaling of economy? So maybe it'll have the same floor plan. Maybe we'll use the same flooring throughout. Once we start going to through the architect and we've found a feasible design, we'll look at the management structure. We're looking at, is it going to be staffed 24/7? Generally, build-to-rent developments are. So you're going to have someone, concierge, to be there, because one of the selling points of build-to-rent is it's much faster at maintenance compared to the private rented sector, where you may be waiting 2-3 weeks for maintenance repairs, depending on how good your landlord is. What's your maintenance pattern going to be? I.e., how regularly are you going to fix things and replace the buildings and the flats as they get out of date? What security features? Again, generally these developments have quite high security. Again, leading to the idea tenants feel safe. They might pay a premium to move into that area with more security. And what's the improvements over the private rented sector? If there isn't many, why would we do it? Maybe we just buy regular rental houses and not even go through all the hassle and the planning and all of this if there's not significant improvements. Once we've decided on how we're going to manage the build-to-rent development, you go to the valuation analysis, and that'll be the development appraisals. You'll start looking at doing discounted cash flow models. We're going to be looking at the end valuation, beginning valuation. We'll be calculating internal rates of return and cap rates. Again, if some of these valuation metrics aren't you're not too aware of, I know Bayfield do a lot of training on this type of stuff. By the end of this, you'll have a decision. Do we do the development or not? And that's what we end up going for. So this is the holistic view of how build-to-rent works and the main decisions that you need to think of when we're going into that sector. Here's just an example of what a build-to-rent development looks like. This is one from Manchester. So I believe it's, I actually checked it. Again, it's still due to be completed in 2025, and they're selling buildings still on the same prices here. So £325,000 per apartment. And what we see here is this is from Maslow Capital. This is a build-to-rent development in Manchester. I believe in the kind of the northern quarter area, which is iconic in Manchester. If you've been there, I go there quite often. They're talking here, if we look at the information that they're using in the brochure to sell this to investors, because we haven't gone to the building this at the moment, they haven't gone to the rental phase, so these are all estimates. They're saying that an investor will get a 6% gross yield if they invest today, and that the capital value of the apartments that you will buy should grow 12% year on year over a 3 or 4 year construction period. And of course, we have actually seen that in Manchester over the last few years. So notice again, this is a prime city centre region. Manchester, of course, has very lax rules on not lax rules, I should say, but favourable rules on development at the moment, because there's a big housing need in the city centre. And we can see here some of the features that they're mentioning here. So the tenants here will get a swimming pool, a gym, as I mentioned before. It's in a prime location. It's going to be managed by Select Property, so that's their managing agent who's going to look after the maintenance and repairs once it's complete. They've got a rooftop terrace, which can also provide additional income through private hire. And then we've got this community feature, which is this residential lounge and co-working space. Again, the impact on the economy was expected to be about 29 million. So the idea is that these are sold up and sold to investors is attractive investment avenues for residential. If you don't want to go into the private rented sector for affordable housing, potentially look at buying one of these, and as tenants move in and out, you'll get a rental return and you'll be able to come to sell it. One of the things that should be noted, though, is when these are being approved for build to rent, the deeds will often state a period of time where it has to be maintained as a rental building, and it can't just be converted into, we're going to build it as a build to rent, and then we're going to sell it 2 years later on. We're going to kick out the tenants and sell it because maybe the value of the apartment's gone up quite high. You can't do that. It might be 20 years, 25 years. It has to remain as a rental property, and then you may have the option to sell it later on. So this can cap the liquidity side on this type of investment compared to the private rented sector. Remember, in the private rented sector, I know this might be abolished soon, we have the Section 21 rules, which means you can kick out a tenant with 2 months' notice with no reason. Of course, there's Section 8(2). Now, that means that you can, in theory, get higher returns because people buying regular property will not value it on a valuation basis, i.e. on a cap rate or doing a comparable analysis. They generally will value it on what their heart is in location to schools, what have you. So if you're valuing it on a rental basis, you may get a lower valuation than you will through the private rented sector. So again, this is a liquidity issue that might be a concern to certain investors. So have a look online about One Port Street View in Manchester. I'm hoping to go and visit it once it's actually done next year. And then if we do this webinar again, I'll be able in the top right-hand corner to send you a real-life picture of this actual One Port Street. It won't take me long to get there. All right then, so we'll conclude on just some of the current trends in build to rent and some of the risks. So we've seen over the last few years that the investment volumes have slowly gone up, and as a percentage of new housing in the UK, especially in the city centres, accounts for about 20%. When you go to more rural regions, Scotland, Wales, Northern Ireland, you'll find that it's much less, much lower, I should say. What we're finding is that younger households prefer this lifestyle, and I should also caveat they probably can't afford to be able to buy a home as well. But some people don't want the hassle of owning a home, the maintenance, so they might not be able to afford it. And so going into a build to rent sector where you feel safe, it's a large development, you're going to be looked after, people are willing to pay it if they've got higher disposable incomes. So we expect to see in the long term more approvals for this, because the idea is that this sector should be better than the private rented sector, which is less regulations and sometimes seen as more rogue landlords. One of the issues with this, though, and this comes to the risks, is what is the future legislation going to be on the build to rent sector, and how will that interact with the private rented sector? Of course, when you put rules on residential real estate affecting tenants, it's going to affect both build to rent and the private rented sector. So when we make legislation, you have to think of both sides. Build to rent generally is more expensive than what you would expect to pay in private rented sector. If you're a student and you've gone into student accommodation, some of these big ones, I'm trying to think, CRE's one, CRM, sorry, Unite Students, I think, is another one that does a lot of build to rent just aimed at students. You find that the fees to live in them type of blocks are very expensive compared to a one-bed flat, say by the private rented sector. So they're aimed at people who earn more money. And so that means that poorer people and not able to afford to live in them. So is that fair in society? That's an ethical question that is beyond the scope, I would say, of this webinar. We often find that for investors, you might find that there's quite a high service charges, because if tenants are moving in and out with the high fees, you'll find there's more wear and tear. And these are big buildings, so they often need quite significant maintenance costs. So you see high service charges. The rent caps can have a large impact on viability. We've seen that the government is and ahhing about putting rent caps on the private rented sector. If they do, potentially a lot of these projects might not become viable if you can't maintain the rent to the market rent, and if interest rates go up. So the long-term viability and the risk could go higher. And so that's an issue that we've seen in Scotland. Debt sourcing, again, has become more uncertain. We've seen interest rates are going down and the debt appetite has actually started to rise over the last year, I would say. But again, these are risky investments. So there isn't as much financing as there is for, say, affordable housing. Like I mentioned before, we've got high maintenance costs. And also what you find is because we're squeezing as many units as we can into one development, you'll find that the square area and the net livable area of each apartment is much lower in build to rents than you would find maybe in the private rented sector. These are often maybe studio apartments, maybe 1 bed at biggest 2 beds. So again, that's kind of the big risks that we have. So people have different opinions. It is a good way of encouraging more rental stock in the market. And that will, again, more stock will drive down prices over the long term, which is good for tenants and is good for competition. Of course, is it the best for all tenants across the spectrum? As we mentioned last week in affordable housing, is it affordable rent? No. Is it social rent? No. So you've got to be careful with who this is targeted to, and actually are we promoting an inclusive community? That I'll leave that up to you to decide on with these type of communities. But thank you very much for